I want to make sure you understand what market making is. It exists in all markets, crypto, stock market, everything. Market making is an activity where a trader simultaneously provides liquidity to both buyers and sellers in a financial market. So liquidity is the degree to which an asset can be quickly bought or sold without notably affecting the stability of its price. Market makers make a market by quoting both buy and sell prices of an asset. So again, they provide the exchanges or the projects in cryptocurrency with these spreads, tighter spreads, the ability, liquidity in the market. Just to give you an idea, is market making legal? Like everybody's like, man, crypto market is so manipulated. It's so manipulated. Well, it's the market makers that do this. Market makers, they must operate under given exchanges bylaws, which are approved by the securities regulator. In the stocks, it's the SEC. As far as the U.S. market makers' rights and responsibilities, which will vary by exchange. So again, just to paint this picture, do market makers manipulate stock prices and crypto prices? Yes. Market makers make money from buying shares at a lower price and then they sell them. The more active a share is traded, the more money a market maker makes. It's often felt that market makers manipulate the prices. Market manipulation is an emotion-based term, and it conjures images of shady deals and exploitation, but it's not really so. Like, they definitely move the price to fill CME gaps. Okay, to take a closer look at these gaps. So this is S&P 500. Okay, traditional markets, if you're not open for a given period of time, like Bitcoin's open all the time, so there's no actual gaps, right? Because it's open 24 hours. Okay, so these market makers, you see these gaps, like these open areas where if the exchange is closed, there's no data, there's no candles here, it's skipped, right? You get these gaps. Okay, you see all these gaps in the price action? The markets are closed then. Traditional markets close every day. Okay, so if you look right here, there's this tiny little gap right here. Like you have to zoom in to see it probably. See this candle? It stops and then this one continues, right? So you get these gaps. Now, even the wick counts. Okay, so the wick stops here and then you see that the next candle starts here. So this gap right here got filled almost all by this wick. So there's just a tiny little, about a $20 gap right there. It's tiny. It's on the 4 hour. It's not even, there's not even a gap on the daily chart. Okay, but then more importantly, here's this gap up here. Huge gap. This means CME Bitcoin futures were closed. Okay, happens on the weekends. And you have this huge gap. There's no candle here. There's no candle. Okay, so there's a bunch of open orders here. There's a bunch of orders right here. Okay, now these market makers, they get paid based on orders getting filled. They get paid a percentage. Okay, so they make their money. They make their money on filling these orders. Okay, so they have an incentive to manipulate the prices to revisit these gaps. Now it could take a month, a week, a year. There's no given set of time that says, hey, this has to be filled at this point. Price at some point needs to run up and revisit this level. And so all these orders back here that are potentially still sitting there get filled. So again, this is a thing where it exists because markets close. And Bitcoin is very tied to traditional markets as well, very tied to the CME Bitcoin futures. Now, if you look, these are previous gaps. So you see here was a gap right here. This is a gap. And it got filled by this wick previously. Like this was May of last year. Gap, here's your potentially a gap, and then it got filled with this opening, and then this candle ran down and it filled all these orders, filled it, okay? And then here, this was, at this point, this was an unfilled gap, and this was an unfilled gap. Well, we know what happened with Bitcoin when it was 10,000. It came back down and it filled these gaps. There's all different kinds of gaps. In traditional markets, there's 12 different gap trading strategies that are very common. You can look up every single gap. We're not going to get into this, but the idea is 99.9% of the time these gaps get filled. Like there's tiny ones. Some people will debate, is it the 4 hour that we need to look at? Is it the daily? Like what, sometimes gaps exist on the 4 hour. They don't exist on the daily. So there's a lot of ideas concerning this and you can't really confirm them. However, in crypto, people have gravitated to this and it's become a thing. And so if enough people believe in something, it's a self-fulfilling prophecy and it will move this market. And people will, they'll basically trade on these ideas like, hey, so enough people are looking for this gap to get filled up here, like 7,300. Possibly, I mean, like I said, it's not filled on the 4-hour, but it's filled on the daily. And then everybody's looking at this number. So what does this mean? People are going to open shorts right here. People are going to go open longs when it, potentially breaks above this with this next level as a target. Okay, so there's a lot to it, but the bottom line here is you just have to recognize that people use this as a strategy and understand it exists, and it's really that simple. Guess who makes on Wall Street? Guess who makes up most of the market maker companies? Banks, large banks. Now, how does this apply to crypto, Chris? You're losing me here. Now, listen, look, this is Tezos, co-founder of Tezos, pointed out in his last blog post. The most natural way to subsidize price discovery in a market is to pay market makers to maintain tight, double-sided quotes. A naive market maker constantly offers buying and selling with a reasonable spread is going to lose money to informed traders. So they pay these market maker permits, funneling a subsidy towards the most efficient forecasters. So they pay the market makers to manipulate this price. The projects do it. The exchanges do it. Here's Blockstack, STX. They hired a company to provide liquidity. They paid a one-time setup fee of $100,000 and a monthly payment of $20,000 for 6 months. And then they gave them $1 million worth of Bitcoin and Ether with 0% interest to fund the trading. So this is basically exist because of these crypto projects and exchanges on purpose. Everybody's like, oh man, these whales are manipulating the prices. That's the exchanges. The market makers are hired by the projects and the exchanges. I bet most people didn't know that. Everybody's like, it's the whales. And yeah, they're whales, all right, but they're doing it on purpose to provide liquidity to the market.